Hey, I'm Sean Tennant, your local Tampa Bay realtor, and I'm here with more Florida real estate facts. If you're looking at different mortgage options, you've probably heard of something called an adjustable rate mortgage or an ARM. So today I'm going to break down what that means, how it works, and whether it might be the right choice for you. So, what is an adjustable rate mortgage? An adjustable rate mortgage is a type of home loan where your interest rate can change over time. That's all it means. It's unlike a fixed rate mortgage where your rate stays the same for the life of the loan. So here's how it works. Most adjustable rate mortgages start with a low fixed rate for the first few years, say 5, 7, or 10 years. This is called the introductory period. So after that period ends, your interest rate adjusts periodically, usually once per year based on the current market, but some do adjust more frequently, like every month. But just as an example, a 5-1 ARM means you pay a fixed rate for the first 5 years. Then your rate adjusts annually after that. So what are the benefits of an ARM? So ARMs can be great in certain situations. So they offer a lower initial interest rate. That's your biggest advantage. It gets you a lower starting rate than a 30-year fixed loan, and that means lower monthly payments, which can free up cash early on. These are good for short-term buyers. So if you know you're going to sell or refinance before the fixed period ends, an ARM can save you money. You get the benefit of the lower rate without the risk of it adjusting later. However, keep in mind there have been periods of time, like the real estate crash of 2008, where people planning to get, with an adjustable rate mortgage, planning to refinance it or sell the house so they wouldn't have to face that increased rate, were not able to do that. So the interest rates had changed, the finance availability had changed, and basically the entire real estate market shifted because of that crash. So some of those people that had ARMs and weren't able to pay the increased mortgage payment that resulted when their rate adjusted, some of those people lost their homes. So there is a risk to this. But ARMs do give you a lot of benefits. They give you that lower interest rate, which means lower monthly payments up front. It's good if you're a short-term buyer, and it gives you more buying power up front. So think about it. If you have a lower initial interest rate, that can help you qualify for a larger loan since the monthly payments will be lower than a fixed rate. You're going to qualify for the same monthly payment no matter what, but if that monthly payment can buy a more expensive home, now you have more buying power. So what are the risks? We just talked about one of them, but let's talk about some others. Your rate can go up. After the fixed period, your interest rate and monthly payment can increase significantly if market rates go up. So that can make budgeting hard if you're not prepared. There's some uncertainty. Unlike a fixed rate loan, you don't know exactly what your payment will be in the future. So if the rates rise a lot, you could end up paying a lot more than expected. If you're planning to stay in the home your entire life, or you're going to pay it all the way off with a 30-year fixed rate mortgage, this is not likely the loan for you because your payment stays more predictable on the fixed rate and you don't have the risk of increased interest rates over time. But if you're looking at or considering an ARM, there's things you should pay close attention to. The first is the introductory period and how long is that fixed rate. The longer the better generally. How often does it adjust? How often can it change? You don't want to have one that adjusts all the time, so an annually adjustable is probably the best way to go. Rate caps. These limit how much your rate can go up. This is really important. If you have one that adjusts annually, you want one that has a cap per year that is reasonable. You don't want to have a 1-year period where your rate shoots through the roof, giving you a much higher mortgage payment that you can't afford. At least give yourself some time to make plans and changes if that looks like it's going to happen. So the other thing to look at is index and margin. So your new rate is based on a formula. It's based on an index rate, like for example, the Treasury bond rate, plus a margin set by the lender. So let's say the Treasury bond rate is 3%. That lender wants to make a 1% margin to make a profit. Your adjustable rate would start at 4%. Now it's just a totally made up rate. It's not one available on the market, but it's one I just had to use as an example. A good lender is going to help you explain all these things clearly. So remember, you're looking for introductory period, adjustment frequency, rate caps, and index and margin. Ask your lender or your mortgage broker to explain all those in detail to you and show you some different scenarios to allow you to pick which ones are the best for you. The bottom line is, if you're buying a home you plan to keep for only the next, say, 3 to 7 years, or you expect to refinance soon, an ARM can save you money. But if you want predictability and you want to be ultra conservative and safe, which I personally do, our rates are already still lower than they have been on average for the last 50 years. So a fixed rate mortgage may be the better choice. But if you're still not sure what's right for you, That's what I'm here for. I work with trusted local mortgage brokers all over the Tampa Bay area. They can walk you through every option. They'll give you clear, honest answers. And if you have questions about something they've told you, come back and talk to me. Otherwise, thanks for watching. Follow me more on here for more Florida real estate facts. I'll be back tomorrow with another video. And again, I'm Sean Tennant, your local Tampa Bay realtor. Thanks for watching.